Hi, everybody. This is Ellman, the blue collar investor, welcoming you to this BCI podcast number 81, titled Managing in the Money Strikes When Share Price Moves Higher. We're going to use a real life example with TriNet Group, Inc., that trades on the New York Stock Exchange under the ticker symbol TNET. Let's start this podcast off by analyzing in-the-money call options. So when we sell an in-the-money call options, we are generating a certain amount of initial time value profit that meets our stated goals. Before we enter a trade, we have to decide what exactly is our initial time value return profit range. We must have that in mind, otherwise we wouldn't know what strike to select. But in-the-money strikes also offer a certain amount of downside protection of that time value profit that's different than the break even. And the amount of downside protection is directly related to the intrinsic value component of the option, or the amount that the strike price is lower than current market value. We'll be breaking that down with this real life trade. Now, the disadvantage of in-the-money call options is that we will not benefit one bit if the price of the stock goes higher, because as we enter the trade, we're agreeing to sell our shares for a lower price than the stock is currently trading for. That is our contract obligation. Now, let's look at a real-life trade with TNET, keeping in mind that the advantage of the in-the-money strike is that we have protection of the initial time value profit. So on June 10th, 2019, TNET was trading at 66.05. So 100 shares were purchased. Now, immediately after being in that covered position, we then sell one contract of the 65 in the money strike at $2.94. And that's for a 7/19 expiration. So it's approximately a 5-week trade. Now, we can't count that entire 294 as profit because we're agreeing to sell our shares for $1.05 less than the stock is currently trading for. So $1.05 has to be deducted from the 294. Now, the BCI spreadsheets will do this math for us. What happens? On June 27th, 17 days later, TNET had moved up in price to 67.62 from the initial 66.05, leaving that 65 strike even deeper in the money. Now, at that point in time, the 65 call was valued at $370. That would be the cost to close the initial 65 strike. So the questions are now, should we close this position mid-contract and perhaps roll out, or unwind the entire trade and move on to a new stock with a new covered call trade? And that is known as the mid-contract unwind exit strategy. And that's what we're going to analyze in this podcast. So if we took a look at the initial structuring of the trade, in this case, we're using the BCI trade planner, but there are many other tools, the Ellman calculator, the Elite Plus calculator, the Elite calculator, all will do the same math for us. We would see that the initial time value return on the option, that's deducting the intrinsic value from the premium, is 2.90%. Keeping in mind that this is a 5-week trade, so that annualizes out to about 29%. Now, we also have downside protection in the form of intrinsic value of 1.6%. What that means is we are guaranteed a 2.9% 5-week return as long as share value does not decline by more than 1.6% by contract expiration, or 5 weeks out. So that's how the trade was initially structured. Now, we know that the price of the stock went up, and therefore the price of the option to close went higher, up to $370. So what we do now is we feed that in to the Unwind Now tab of the Elite calculator, Elite Plus calculator. Those two calculators have the Unwind Now tab in them, and feed that information in. So we put in that the current price of the stock went from 66.05 up to 67.62, and the option went from 294 up to 370. That information is entered on the left side of the spreadsheet in the blue cells. Then the white cells on the right side of the spreadsheet become populated. So here's what we need to know. The time value cost to close is 1.66%. Okay, now 1.66%, if we did close that, what we have to ask ourselves, can we generate 1% more than that with 3 weeks remaining in the contract? In other words, can we generate 2.66% in 3 weeks? Now, is it possible? Yes. Is it guaranteed? No. So why should we then take that chance? The strike is deeper in the money now than when the trade was entered, which means the downside protection of our original time value profit is protected to an even greater extent. We're even in a better position. Now, rolling is something we won't consider until we get closer to contract expiration. So the exit strategy that we consider at this point in time is the mid-contract unwind exit strategy. And in my opinion, 1.6% cost to close, meaning we need to generate 2.66% or more in 3 weeks, does not justify taking that action. So at this point in time, I would say that no action is the best action. Now, we sure do continue to monitor that trade, and if the price of the stock goes even higher, rendering the time value cost to close even lower, that may become a different story. But at this point in time, I would take no action at all. Let's summarize. After selling in the money call options and share price accelerates, rolling options out should be reserved as we approach expiration on expiration Friday, or the days just around it. Now, we may close the near month short call if the time value cost to close approaches zero using the mid-contract unwind exit strategy. What we do there is use that Unwind Now tab, determine the time value cost to close, and then ask ourselves this question. Can we generate at least 1% more than the time value cost to close in a new trade with a different underlying security? The answer is yes. We move right on with the mid-contract unwind exit strategy. If the answer is perhaps or no, then we just leave the trade alone as is. Before I close, folks, I want to remind everybody about the huge free resources on the bluecollarinvestor.com website. Use the free resources link to download the calculators, the basic Ellman calculator. We have a single column put calculator and many other files that are free resources. Also have a look at our Beginner's Corner tutorials for covered call writing and selling cash secured puts. And do visit our store where we have a multitude of online classes, books in various formats, ebooks, soft cover. A few of our books are in hardcover. We have calculators, spreadsheets, mentoring programs, and a trade planner that you saw we discussed in this podcast. So many resources available to help us master. Go to www.thebluecollarinvestor.com, and there you have all these resources I alluded to. So folks, I want to thank you so much for taking the time to listen to and perhaps watch this BCI podcast number 81, titled Managing in the Money Strikes When Share Price Moves Higher. Hope you enjoyed it, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.